What's up? One of the things I love is real estate. My name is Mark Pattison, and I'm going to talk to you about real estate rentals. And this is going to be a step-by-step guide of how to take your first place and turn it into a cash flowing machine so you can do it again and again, rinse and repeat. Let's talk about the first steps. So when you're going out to buy your first rental, it matters about your down payment. So I'm already assuming you own a house. You've got that down. You got your primary residence in place. Now you're looking to buy the next place, and it's going to be a rental property. I always suggest when I'm going after rental properties, if you can get more units, the better. So if you're looking for something, maybe 2 units, 3 units, 4 units, get something that's in that area, in that realm, depending on affordability, and we're going to go from there. Typically for a down payment for your rental. So step one is getting that down payment down, getting it saved. It's about 20%. You can find some lenders that are going to do 15% depending on the unit count, but it's going to be anywhere between 15% and 25% down payment. Once you have that saved up, you're going to use that for your loan to buy the place that you're looking to turn into a rental. Next thing you're going to need to work on is make sure you have good credit. So when you're buying a place, you can of course get a loan. You don't have to have perfect credit, but the better the credit, the better the terms. So remember is that when you're going to look for a lender, they're going to want to know your credit score. They're going to run a credit check for you. So that is going to be a ding. They call it a soft pull, but make sure that you're not shopping around like crazy and pulling your credit score and figuring that out. Go to one lender that you trust, someone that hopefully your real estate agent refers you to, because your credit being pulled is going to impact you. It's not a hard pull. It's nothing crazy, but that way you're going to know what your credit score is. Do this early on, just in case if there's something on your credit that you need to have cleared up. I had something, what I did was I switched insurance companies. My old insurance company sent me their last bill. They changed their name from, I believe it was Allstate to something else. And when I went to go pay it, it said that I didn't owe the money. It was $200. It impacted my credit score because it was delayed, got sent to collections. And this was a bill that I didn't even know about, and I think it was a $200 bill. So make sure you pay attention to your credit. Make sure you have some sort of monitoring system because that's going to save you thousands of dollars, of course, to life of what you're going to own on rental properties and the payments that you're going to have to make because the different types of loans that you're going to qualify for. But once you have your credit in place, you're going to also have to have your tax returns. Yes, your lender is going to ask you for your tax returns. Now, if you don't have your taxes filed, that's not an issue. There are types of loans called non-QM, something that where you're not going to have the best rates, but if you need to buy that investment property and it still pencils, meaning maybe it cash flows or however the scenario is, you can go in and get a non-QM loan without your tax returns. Maybe that you don't make enough money. Maybe you did your tax returns, but it's not showing enough that you have enough. Maybe you're a hairstylist or you're a 1099 employee. However it is, you do need those tax returns though if you do want the best rates. So make sure you get those ready to go because the next step is when you talk to that lender. So talking to lenders, someone that you want to know, like, and trust, maybe someone that was referred to you by your real estate agent. I personally like to go with the smaller loan companies, someone that's maybe a mortgage broker, someone that can shop around for me, find me the best rates, but not necessarily just the best rates, but also the best terms. They can understand my situation. If you're maybe not a normal W-2 employee, maybe you're self-employed, or like I said earlier, 1099, you may have to have a little bit more of a creative financing solution. Local lenders or mortgage brokers are going to be those go-tos that you're going to want to talk to. They're going to be the ones that are going to get you the rates. They're also going to be the ones that are going to be able to close, and they're not going to come to you at the 11th hour and say, oh my gosh, I'm so sorry. We didn't realize that you were self-employed, or hey, we didn't realize that you banked with that bank and we need you to bank here. Those are the types of hiccups that you will encounter. That's lending in general. Having a local lender, it's going to have those a little bit less and hopefully a little bit smoother of a transaction so that you can close on time for that investment property. So while you're shopping, you talk to your lender, you get a little bit of an idea. You may want to know, hey, what is my mortgage payment going to be? So it's not going to be exact. Your lender will actually be able to run numbers for you. But say if you're just trying to run numbers on the fly, I go to bankrate.com. It's a super easy mortgage calculator. Give you an idea of what your rate is going to be, give you an idea of what your payment's going to be, and it's going to break it down into a couple things. It's called PITI. Now that's your payment, your interest, your taxes, and your insurance. So when someone tells me what their payment is for their house or their investment property, you need to make sure, hey, are you talking about just your payment? Are you talking about your payment and interest? Which a lot of people, they just talk about P&I. They don't talk about the taxes and insurance. So if your all together PITI is $10,000, that's a big difference than if they're just quoting $10,000 on your principal and interest. So make sure you're very clear to include all those items when you're talking to a lender or you're looking at a mortgage calculator online. A lot of the times they won't include the tax rate. You do have to put in the zip code or the area because everywhere changes depending on property taxes. And that's how you're going to figure out your PITI. When you're going and comparing apples to apples from one investment property to the other, you can go and look at what your payment will be, which is great to know, of course, but it really doesn't tell you the full story. The full story of knowing apples to apples comparison is going to be something through cash flow, and it's going to be something with a cap rate. So understanding what your cap rate is going to be on the property is something that you're going to have to calculate. Your lender's not going to do this for you. Your real estate agent may do it for you, but I would highly suggest working with the real estate agent that works with investment properties, and that's their entire business. Of course, the residential family homes, that's great, but the investor real estate agent is going to know a little bit more about cap rates, gross rent multipliers, and other ways to compare one investment property to another. You may be shopping different cities. You may be shopping with different real estate agents, maybe one in San Diego, one in Las Vegas, one in Tampa. You can't use the same agent for all of them, but you want to know what are the rates between each city. Some places you're going to have high cash flow. Some places you're going to have a higher equity return. You need to look at your investment strategy and what you need. As someone who is younger, I would probably suggest you don't need necessarily too much cash flow. You probably want more of the equity game. What the equity game in my book is you're going to buy something that you see the potential of gaining equity a lot more than maybe something if you were just get cash flow today. Right now, I personally don't want cash flow. I don't want more cash that I'm just going to spend or more cash that I'm going to have to pay taxes on. So instead of doing something that's cash flow heavy, I look at stuff that has more opportunity. So something that maybe a longer investment, maybe somewhere where I have to buy a property, get it entitled with the city for development, maybe takes 3-4 years, get that project developed, or even sell off those entitlements to a developer and then make the money on the back end. 1031 that property into something else and do it again. That's going to be more of an equity play because I don't want that cash coming to me every single month because at the end of the year, I have to show on my Schedule K that I made X amount on my rents, and that's going to be an increase in my income, and I have to pay more in taxes. So I look for not necessarily anything to do with your cash flow or your properties for your gross rent multipliers or your cap rates. I look more for opportunity. Now, if you're looking for something where you want cash flow, your cap rate is an easy way to do this. And I'm going to teach you how to do cash flow and cap rates. Cap rate formula is you're going to take your gross rents. So what that means is that say you have 10 units and all of your units are paying you $1,000. Well, your gross rents per month is $10,000. It's $1,000 for each one of those 10 units. That's $10,000 for gross rents. Now, typically expenses in San Diego and with property taxes, vacancies, etc., you're going to want to subtract around 30% of that gross rent. So what you're going to look at is around $7,000 per month in net rent. Now, that is what you're going to get for your net income. But incomes matter for the year and your annual. So you're going to take that $7,000. There's 12 months in a year. You're looking at $84,000 in net income. That's money that you're going to take out. Remember, I don't like that because then you have to pay tax on it. So it's a little bit different of a game, but that's what you're going to have is $84,000. You take your net income and you divide it by the purchase price. So let's say that the property was maybe $1 million. So now it's $84,000 divided by $1 million. That is going to be your cap rate, which is 8.4%. That is a stellar cap rate. If you're looking for maybe something that doesn't, if you're looking in a city like San Diego or Seattle, New York, bigger cities, cap rates are typically lower. A good cap rate in those major cities is going to be around 5%. If you can get higher than that, hats off to you. Some ways to increase cap rate is to maybe add storage to the property, maybe charge extra for parking. Maybe you can do an Airbnb or short-term rental versus having a regular rental income. A short-term rental will give me about 2.5 times what I can make on a regular long-term rental. Now, it's going to be harder to get lending if you're only banking off of those short-term rental numbers because the lender's not going to take that into consideration. They're going to want to do a rent roll and look at what the rents are going for in the area for rent comparison of a long-term property. Remember, long-term property is what they're going to loan on. So if you can make $1,000 like we talked about in the regular long-term, you can't go and quote on the numbers for your loan that you're making $2,500. Even though realistically with your Airbnb, short-term rental management, you're going to probably make around $2,500 a month if your regular long-term rents are $1,000. So know that you can about 2.5x what you can. Now there's seasonality. There's a couple different websites you can go check out. One of the ones we use is airdna.com. You got to take it with a grain of salt. Look at your competition and don't just look at what they're charging per night, but really click on the calendar and see how much occupancy they have. See what they're charging on busy weekends versus the weekdays. Those numbers drastically change. People ask me all the time, what do you charge per night for your Airbnb? Or what do you charge for that one? Well, it's not about a per night thing. Is it a weekend? Is it a weekday? Is it a holiday weekend? All those factors matter because it's going to fluctuate on how much money you're making. Now, if you're going to go take those, that's why a lender won't necessarily take it into consideration because there's too much up and down. But if you look at it across the board, it's going to be about 2.5x like we talked about for your rental income. So when you're looking for an agent, you're going to find someone that is going to be fluent on investment properties. Now, it's great for those referrals and those family friends and that agent that maybe is your cousin or someone, but you want someone to protect your assets. And this is a huge property investment. You're going to be spending a lot of money on this. So I want to make sure it works for you. My team and I specialize in investment properties. So head on over to porchlightrealtyteam.com. We're based in San Diego, but we have teams all over the country. We also have Porchlight teams all over. So if it's not one of us, we have someone that we align with directly that's in the same coaching companies as us that knows how to run these numbers and knows how to get you in the property that's going to get you what you need and what works for you for your investment. So make sure choosing your agent is a big deal. Make sure you take the time on that and make sure you choose the right agent. Ask them questions about cap rate, gross rent multipliers, find out what they know, if they have any off-market properties for you, something where they maybe work with investors. There's a lot of off-markets because as investors, we're not necessarily tied to that property. And if someone comes along and offers us the right numbers, all of our properties are essentially for sale. Most of these properties, the seller is going to have to do a 1031. What that means is they're going to be selling that property to you and they're going to be reinvesting those funds equal or greater into something else. Typically, you're going to have to work with them on their timing because if they can't find something or if they can't locate something in time, they're going to delay your closing and they're going to have contingencies in place that are going to have that to protect them. So make sure you understand what is that seller's intent after they sell, what laws protect them, what protects you so you don't lose your deposit. And good agents are going to be able to help you represent that. Make sure that they can actually dissect what's going on for that problem for you. And they're going to be able to get you that deal that you've always wanted to make sure you cash flow or get those equity gains that you deserve. After you find a place, your agent gets it under contract for you, one and done. It's always that simple. Just kidding. Sometimes it's going to take you a few tries. When I wrote my first property, when I was looking to buy, I was actually moving into it. I was looking for an investment though. I was buying a duplex with an FHA loan, 3.5% down. Now I know I said you had to have 15 to 25% down, but since I was moving in, I was able to buy a duplex 3.5% down for my first property in San Diego. I moved in one unit, rented out the other side. It took me 8 tries to get my offer accepted on 8 different duplexes. Finally, I got my offer accepted and I'm super grateful it was the one that we got because that thing is just absolutely crushing the Airbnb market. Right now, my mortgage, I believe, is around $2,200 a month and I am netting at least $10,000 every single month. It's almost a full-time job of income coming in off of a property where I put $17,000 down. Now, it's super simple. People always say, oh, I don't want the headaches of that Airbnb or I don't want that. It's like, well, if it can make as much as a regular full-time job, sign me up. Do that times 10. Let's rip off and duplicate whatever plan that was and just keep scaling it, doing it over and over again. So once you get that place with that agent, you're going to go and you're going to do inspections. Typically in your contract, you're going to have days to inspect it. And if there's anything wrong, you can maybe negotiate with the seller or you can go and make sure you get a credit, whatever the scenario is, but it's up to the state. It's up to the contract. So make sure you check with your agent on what's allowed in your area. Typically in Southern California, you're going to be able to negotiate that with the sellers. And whatever is not up to working order, they can usually repair or give you a credit for it. Now, it also depends on how many offers you're going to have on that property. If you have multiple offers and you're beating out other agents and other clients on that property, you're probably not going to get as much from that seller because they're going to have a backup offer in place. They probably will accept yours and they'll say, hey, we'll accept your offer, but it's as is. What that means, you're not going to be able to do repairs. But that's fine as long as nothing is major. And the 4 major items that are going to be the big ticket items are going to be your roof, plumbing, electrical, and foundation. Now, you should have something in place where you can still inspect it. So if something is wrong with those big 4 items, you could back out or you can maybe go back to the seller again and be like, hey, I know you said you wouldn't fix anything, but I found this huge crack or I found this something in the roof. It's going to be 20 grand. I don't want to pay for that. Have that in place. Make sure your agent goes over those items with you. Make sure that you can go through detail and see what you can and can't get done. Now, once you have it inspected and you remove contingencies, you're moving forward with that. The loan's good to go. You close on the property. You get the keys to your new crappy duplex or threeplex or fourplex, and you're going to start remodeling it. How do you pick a contractor? One, get suggestions from your agent. I would make sure that they're a licensed general contractor that's bonded and insured. You're going to make sure that they give you a bid. You're going to want timelines on there. When do they start? When do they finish? Is there any overages, a per diem? Say they're going to finish October 5th. If they finish October 6th, is there a penalty against them? What in line do you have in the contract to protect you as an owner so you're not stuck there with this property that's not done? There's always things that are unforeseen. There's going to be a little bit of change orders, things that happen, but really have those things in place because contractors love to overpromise and underdeliver once they get you under contract. They get you moving and all of a sudden they're just asking for more money, more money, more money. Pretty soon you look around and your place isn't even done yet and you start off with a nightmare of a project for your first investment. That's not how you want to do it. If you're going to have this, you're going to get a bad taste in your mouth and you're never going to want to invest again. But if you put these actions in place up in front, then you're not going to have those issues. So make sure you get a few contractors out to give you bids. Don't go with the cheapest one. Go with the one that you feel that has the most experience, the one that works and also within your budget, also the one that works on your timeframes, because the sooner it gets done, the more that you can get that money just right in your pocket from rentals. Once you have it all remodeled and ready to go, you're going to want to work with a short-term rental specialist, or if you're local and willing to do it yourself, you're going to save about 20% on that, but you need to make sure that you know what you're doing, because even though you can save money, if you don't know exactly what you're doing, it's going to cost you more than you think, and you're going to end up paying for it anyways. So it's almost better to partner with the short-term rental management company. Now, we have one here in Southern California that we own. It's called 31 Beaches. You can go to 31beaches.com, check it out. We do hosting. We do different webinars. We teach you guys how to do this property management, but I always suggest hiring a professional. You get what you pay for. And one thing my coach always said, Tom Ferry, shout out to you, is if you pay peanuts, you're going to get monkeys. So if you're cheap and you're not willing to pay someone, you're probably not doing it the best way anyways. So make sure you pay a good property manager to get the most out of your investment as possible. All right, once it's rented out for a year, you're going to take those numbers and you're going to be able to show that lender and say, hey, look, I've got a cash flowing asset. Let's do it again. You can do different things to get it done faster, but in order to save up that 20% again and have that money there, offset what you have for the rentals, go ahead and do it again once a year. Slow but steady. And if you think about it, if you did this one a year and you had 10 different duplexes after 10 years, you could sit back and retire. Now, this is why I strongly believe in having this type of asset over maybe a 401k or a Roth or any other retirement plan. I'm not saying don't do them at all, but I don't think that that should be your focus. I truly think that your focus should be real estate, because as the economy changes, rents go up. So does your assets. So does your how does your property, your monthly income. So say in 20, 30 years, the cost of the dollar is going to go down. It's going to be cheaper to get a dollar than ever before. The value is not going to be there. And so what we're going to do is go and say, hey, let's go and look at the rents. The rents I guarantee are higher on my properties. That way I can look back. My mortgages could be paid off in 30 years because I have a 30-year fixed rate properties on our 30-year fixed rate loans on each property. And then I'm going to have all these properties paid off and I'm going to be sitting pretty with X number of rentals. And the more you do, the easier it gets. Pretty soon also, you'll be able to take those properties. And like I said earlier, you're going to do a 1031 exchange. You take maybe 3 or 4 of them, sell them off, package them into a deal for maybe an investor, and then you go buy something bigger. Maybe you take 6 of your doors and you go buy 11. Or do what I did. I took 3 doors, sold them for 1.2, and I bought 11 doors for 1.5, rehabbing them right now, getting it going, getting that all entitled as well. So with the city of Henderson, Nevada, and then I'm going to take that entitlement and I'm going to be able to do 54 units. So I took 3 units to 11 units to 54 units, all by doing one property with a 20% down investment. And that 20% down investment, I think, was around $120,000, which, yes, I understand that's a lot of money, but I was able to take a previous property to put it into that one. So it's all stepping stones, guys. You guys know the game of Monopoly. That's exactly the game of life. You go and you take properties, you group them together, you buy a hotel over and over and over again. And then you go around And I don't know if you ever seen the video when the little kid's crying and he's saying, all my money went to taxes. And he said, I don't like this game. And the parent's like, well, welcome to life. There are ways out of it, which we'll do more videos on. And I do have videos, if you're a real estate agent, of how you should buy your first property. There is a video on that, so check it out. But guys, I'm telling you, real estate is the way to go. If I sound passionate about this, it's because I am. I know how it works, and it's stepping stones. You're not going to get rich quick, but I guarantee you will get rich, and it's just the path of the slow and steady. The tortoise wins the race, as we all know. So be the tortoise, buy some real estate, wait a year, buy some more, wait a year, or hell, even buy a little bit more, just keep going. And then all of a sudden you sit back and you're the monopoly man owning most of the city. All right, hope you have something, hope you learned something, and chat soon.